While I want to look at the intraday graph of Alok Industries, 38 rupees stock, 5% down, 5% higher. That's a 10% intraday swing if you just look at the stock of Alok Industries today. Let me also refer to Motherson Sumi, which came out with numbers earlier this week. That's trending up very, very smartly. I mean, here's one management who comes out and says, nothing's changed for me. It's business as usual. COVID, no COVID. What an amazing and a bullish commentary. But I want to look at that's PI Industries, guys. I want to look at Alok Industries. My producer is just going to fire Alok Industries, and Alok Industries, the intraday graph is telling you that there is definitely an element of very wild volatility in a stock like Alok Industries. 4%, 5% lower, 5% higher for Alok Industries. Motherson Sumi is the other stock where we've seen a very sharpish kind of an intraday recovery. Well, defense was a strong theme 2 days ago, but today very little follow-up buying is there in defense as a theme and as a category. I'm also going to touch base with the management of Titan Industries in moments from now. Actually, the management is ready, so let's connect with them. Mr. S. Subramaniam joins us now, CFO with Titan. Mr. Subramaniam, good morning. Thank you for joining us. How has unlocking been in last 1 or 2 months? And now that stores are opening up, has demand really come back? Update us to and walk us through what's happened to footfalls also.
So our stores basically started opening up in May, yes, but most of them in June. And I think as of now, about 85% or so of our stores are open. But the issue is that when I say they're open, it doesn't mean they're open all days, because in many states there are alternate day working, etc. So wherever there are lockdowns in localities, the store operations do get impacted. So all we're talking today is just about the total number of stores that have been open or are open at this point in time. So obviously this is impacting our revenues. It was expected, of course. The good news is that it's actually what we are seeing is better than what we anticipated in April, May. So June numbers for jewelry particularly were much better. July, I think we've said already that we are actually a percent more than last year's July in terms of revenue. Having said that, there is also a base effect there and some advancement of the activation that we did. But on a like-to-like basis, we are looking at least 80% of last year's numbers in July, which is a very, very good sign that we are getting traction back on the jewelry segment. August so far, same thing. We are actually tracking ahead of last year, so that's a very good sign. The other two businesses, which is watches and eyewear, are impacted, and they are, I think, impacted because of the nature of the category. Watches clearly very discretionary in nature, while jewelry, there is this whole issue about gold and store of value and the asset. The attraction as an asset class, all of those are helping them. And along with, of course, whatever weddings are happening also, people are buying it for those reasons. Whereas you don't have the same reason in watches as much. Eyewear is a more intimate, interaction with the store. And therefore, I think people are postponing purchases at this point in time as much as they can. But I believe these will come back to normalcy fairly soon. The way we are seeing is that at least in Q4, we should be looking at growth and normalcy for sure. Q3 is where we are hoping will be much, much better. Q2, we will have ups and downs. July, August is not bad so far. September, I think there's the inauspicious period, which is extended. So we may see slowing down of jewelry sales at that point. But otherwise, I think it's not bad so far.
Sure. But usually higher gold prices also alter the customers' buying behavior adversely. Given that gold is already near an all-time high level, how confident are you of maintaining the July trend when it comes to the jewelry segment?
Market share gains that I'm sure we are getting, because from what we understand the street, I don't think other jewelers are doing or have recovered to the extent that we have recovered. So I think that's very clearly happening. As far as gold price itself is concerned, I think there are different aspects here. One is that I think, as I said earlier, the investment avenues for many people seem to be limited now. Stock markets, yes, they are going up and down, but not where everybody is comfortable there. Debt markets yields are much lower. So, and with inflation, threat of inflation, etc., and gold prices going the way they are, it looks to be a decent asset class for many people. And therefore, there are higher investments in plain gold jewelry, for sure, that we are seeing here, despite the high prices. So people possibly are expecting higher prices in future. So we don't know. But that's something that we are seeing. The second thing is that, as we were saying earlier also, our hypothesis is that most people spending as such has come down. People are more looking at spending on essentials today. A lot of the discretionary spends which otherwise were happening, which is essentially travel and going out and so on and so forth, that's come down substantially. And that may also have resulted in people having more savings, and which possibly is going back to gold. So I think it's a combination of these. We can't precisely say exactly how much each of them are contributing, but this is how we believe it's panning out.
For the jewelry segment, are you also seeing competitive pricing pressure, especially given that the informal, the unorganized sector will be sitting on pretty large inventories?
There have been some cases, some cities, etc., where there have been reduction in gold rates and making charges and so on and so forth, but we are not seeing across the board. And as I mentioned, it doesn't seem to be impacting us anyway, because we are gaining share everywhere. So I don't believe there is a significant reduction in gold prices because of the increase in gold and the fact that others may not have been hedged. And that's, I think, largely to do also with the fact that the way people look at it is very different. One doesn't look at just the gain, because they also are looking at what they need to invest. So if they discount gold rates now, they also need to invest at the higher rate, and which means they lose later. So I don't believe many jewelers would go about discounting indiscriminately, and that's very, very evident. We are not seeing that at all across the board. Some here and there you find promotions. That's because people want to liquidate stocks. That is understandable. Other than that, we're not seeing anything significant.
Okay, so given the mixed trend, high sales of gold coins, low studded ratio sales, could we expect margins to be under pressure for the next couple of quarters?
Yes, I think that I can accept. There will be pressures on margins here, because this is a time when people are looking at buying gold more as a store of value and, as I said, an asset allocation. It is not so much about discretionary spend. So diamonds are clearly not in favor as such. Most jewelers, most customers, even those who used to buy diamonds earlier, are looking at buying gold at this point in time. So to that extent, yes, there will be a margin erosion. We have seen it so far play out in June, July, and maybe it's continuing in August as well. So this is something that we think is going to happen. But I think what we are trying to also do is to see that, well, that happens, we could possibly increase the gold sales and target that more.
Okay, and with work from home now being the new norm, consumers may not be looking to purchase watches at the moment. Are you looking to enter into the home segment in any way? What's the plan there?
You're right about that. People working out of home don't feel possibly the necessity to even dress up. Forget wearing watches, right? But I believe these will change over a period of time, and it depends on how long these things carry on. And I also believe we'll get back to normalcy in a reasonable period of time. So in the interim, it's going to be a little challenging, no doubt. Of course, the good thing we did was invest in the digital platforms that we have now. A lot of that is working well. E-commerce is a big push also. The last few years, we've seen sales in our watches and wearables division go up substantially on the e-commerce platform. Today, it contributes more than 10% of our revenues. Therefore, the omni-channel play, the e-commerce play, all of these would to some extent mitigate this issue. But it is going to be challenging. We are going to see watches take far more time to get back to a normalcy.
With the impact of the gold hedges, especially on your P&L, because that has created some confusion for investors.
This whole concept of hedging, ineffective hedge, etc., is a very complex subject. It's quite difficult even for chartered accountants to understand very easily. We are most probably going to put up a note which will explain this in far greater detail. But let me just try and make this as simple as possible. The first thing is that we hedge our gold entirely. So we don't get exposed to gold rates at all. So we don't either make money nor do we lose money. However, having said that, the hedging norms require us to designate, which means say in which month we are going to hedge. So if I buy something in April and I say I'm going to sell this in August, and then I have designated the sale to take place in August. And we follow what is called a cash flow hedge. Now, if the sale does not happen in August, you end up with what we call an ineffective hedge because the sale does not happen, or the quantity is higher, lower, etc. You do have issues on that. So then what we have to do is to take that into the P&L, the difference between the quantity which has not been sold and into the rate. And as you've seen now, over the last 4-5 months now, we've had significant shifts. Obviously, the sales plans have been totally, whatever we planned earlier and the designations that we made for gold to be sold in Q1 has entirely gone out of whack because of the COVID situation, which means that you will have what we call ineffective hedges. What has compounded that is that the gold rates have gone up very, very substantially, which means that the impact on the P&L will be high. Typically, for quantities which have not been sold and which will be sold later, whatever losses are booked now will be recovered. So there's no issue on that. Having said that, there are other complications in the sense that inventory gains also have happened simultaneously. So those also will get reversed. Inventory gains are happening also because of the same reason that gold rates have gone up. And we value inventory on a FIFO basis. Therefore, the older gold rates, which are at lower rates, get charged to P&L now. The higher rates will get charged later. So there are these mismatches which are going to happen, and it could be fairly material in these 1 or 2 quarters. It's happened in the past, but not as acute as what we are seeing now. This is a compounding of both sales plan going awry and gold rates going up very, very substantially. So we are in very unprecedented times. So these mismatches are happening. So while the losses on ineffective hedge will happen, we may also have losses coming out of the stock gains, which will reverse. So they will, in a way, net off each other by and large. And we'll try and, as I said, explain this more. We'll put it up on our website and so that people understand this concept of hedging a little better.
Right. Every company has resorted to automation and cost cutting. Some are by choice, some are by compulsion, some are purely by discovery and plugging out inefficiency. What's your strategy to cut cost? Where do you think you are headed there, or where do you think Titan is headed?
See, on the ineffective hedge part, frankly, the P&L impact of whether it's effective or ineffective should normally be neutral. Okay, therefore, all it matters is where it's being shown. If it's an effective hedge, if the same hedge had been effective, it gets netted off in the revenue. Whereas if it's ineffective, it's shown as a line item in the P&L account. That's why the other expenses, for example, have gone up. Okay, so typically, if nothing had happened, if rates had been, say, flattish, and there was still an ineffective hedge, it would not have impacted the PBT as such. Okay, so that's how this works. And we'll call out that number also so that people understand what component of other expenses included this. Now, the issue is that having said this, we are, as we mentioned earlier, working on this War on Waste program. We started this well before COVID. So we started this sometime in December as part of our planning exercise this year. Those savings are kicking in. We are getting a lot of that. Of course, beyond the War on Waste program, there have also been cuts in employee compensation, etc. So those also are going to happen this year. So this is a year where we will have significant savings on costs. And hopefully a lot of the savings will also be sustainable, which will carry on to the next financial year and beyond. And to that extent, I think this is a great opportunity to relook at our costs entirely and get a stronger base so that our margins do start going up from next year when we expect normalcy to be there entirely.
You also incorporated a wholly owned subsidiary called Titan Commodity Trading Limited. What is the purpose of this company, and why now have you, brought this company into existence, considering that you've always been dealing in commodities?
The main reason is that we are looking at becoming a member in one of the exchanges, commodity exchanges. And the idea is that sometimes we do have third-party risks when we go through brokers. When we hedge, we have to hedge a lot of our gold in the MCX, and we've had some issues. I'm sure you guys know what we're talking about. We've had some issues with some of the brokers who are facing liquidity issues. So one of the reasons we are looking at the subsidiary is to do it actually directly if we can be a member of MCX, so that we don't have a third-party risk at all in this case. So that's a primary reason why we are doing this.
Okay. You've also said that launches will be postponed to Q2. Are we on track with those across segments? Any further adjustments?
I think you're talking of the collections, I presume, right? The jewelry collections. And you must have seen Aramba already there in the market. It's being advertised and so on. So yes, they will start happening. Watches, we've just started the connected watches. You must have seen that ad also very recently. So there are exciting products coming up, exciting collections coming up as we speak. So obviously in first quarter, we could not have done anything with stores all being shut. Second quarter onwards with a semblance of normalcy coming back, I think all these will come back. So hopefully there should be enough and more to excite customers in the next few quarters.
All right, Mr. Subramaniam, we'll leave it there. Thanks so much for joining us this morning. Let's take a very quick break. We'll be back with more others.